Okay, hello everybody. Thank you very much for joining this. This is the 7th in the 2021 series of America's FIXinars. We're talking about the future of automated trading. We have an excellent panel for you this morning or this afternoon. So very much looking forward to hearing what they have to say on this very, very broad and interesting topic. Just a couple of points of order, if I may, before we get going. We'll have about 40 minutes or so of the panel itself. There'll be some time for Q&A at the end. So if at any point you want to ask a question, please feel free to do so in the chat function on your Zoom. Just pop a question in there. We'll collect them at the end and go through those. That would be excellent if you can do that. And also, if anybody wants to use quotes from any of the speakers, and that includes people asking questions in the Q&A, we have a quote checking policy in place. So you'll need to contact the program office, email details at the end of the presentation, so we can have the quote approved by whoever originated it. I hope that's clear to everybody. And with that, if I may invite our panel to sort of display themselves and unmute themselves, let's get going with some introductions. So perhaps Ashley, may I hand it over to you to introduce yourself?
Thanks, Jim. Good morning, good afternoon, everyone. My name is Ashley Krustalski. I work for Virtu Financial. I've been here a little over 3 years now. My primary focus here is workflow technology with a focus on the EMS product strategy and new business development, including our suite of automation tools. Prior to working at Virtu, I worked at Instanet for 6 years in various roles across product sales and coverage for their suite of client-facing technologies. Excited to be here today.
Ashley, thank you. Dennis, would you like to introduce yourself?
Hello, everyone. Good morning. So my name is Dennis Amaev, and I run the algorithmic trading development team at Cantor Fitzgerald, but I guess my career in fintech began almost 20 years ago in a basement startup. Actually, we were building electronic trading systems. And so prior to Cantor, I was with JP Morgan for a number of years, and before that with Bank of America Merrill Lynch, and various startups before that. Happy to be here.
That's great. Thank you very much. Enrico, over to you.
Yes, Enrico Cacciatore over at Voya Investment Management, a senior quantitative trader, and also focusing on our market structure and trading analytics, as well as a chair of a IMAC, which is Investment Management Advisory Council, part of CalCard technology, really trying to advance the transactional data layer with governance, security, and content. And IMAX, that council, is really trying to attempt to really put real-time transactional data available and permissionable in a cloud environment.
That's great. Thank you very much. George, over to you.
Hello, fixed trading community. My name is George Claderis, founder of Limni Trading in New York, and I am registered with Velocity Clearing, LLC. I'm a serial entrepreneur in institutional electronic trading and have worked with FIX since 1996. Most of my career has been about finding ways for institutional asset managers to lower costs and reduce risk through efficient networks of execution venues like automated brokers and exchanges. I am now working on including those same efficiencies to smaller professional trading groups using data-driven API technologies. And I am excited to be here.
That's good to hear. Thank you very much indeed. I love your painting. That's very nice. Mark, over to you.
Thank you. And like others, I'm also very excited to be here. Hello, everybody. I'm Mark Waters from Axe Trading. We are a software company headquartered in London that provides cutting-edge fixed income trading technology to sell-side firms, brokers, the buy side, and also trading venues. And I have a career 25 plus years in fixed income electronic trading, automation, and electronification of fixed income workflows. Very, very excited to be here as well and looking forward to the discussion.
Thank you very much, Mark. Thank you very much, everybody. So now we all know each other, and hopefully participants, you know who we are too. Let's get straight into it. I think the first place we need to start here is we have a topic of automated trading or trading automation. That's a really broad pairing of words. It could mean, you know, almost anything to a number of different people. So let's start by just defining what we mean by that. Ashley, I mean, let me hand over to you. What does trading automation mean for you and your organization?
So from a vendor perspective, our platform offers automation for equities, fixed income, FX, options, futures. Automation is a tool for us, for our clients, to reduce their workload and reduce their operational risk, right? But people think of automation as, you know, totally hands-off. There's a robot or a script doing everything for me. From a vendor standpoint, your workflows can be semi-automated up to fully automated. So you can think for things as basic as the concept of writing a rule to trigger a pop-up to remind you to trade or revise an order, right? That same trigger can then create orders for you if certain conditions are met. From there, you can route that order to an algo wheel that will intelligently allocate that flow, right? Or if you want, you can have the platform auto route your orders entirely at arrival, right? We have people writing multi-tiered decision logic, you know, that could be one line, it could be 100 different lines to automate those orders. So for now, automation runs the gamut from the vendor perspective, right? You can use it to trigger templates, you know, to trigger alerts, or you can use the platform solely for exception management, right? Whatever your appetite is, there are tools available at your disposal.
Thanks, Ashley. That's good to know. Mark, you're obviously on the kind of solution provider side of things as well. How do you see things that you provide actually being used and impacting trading automation?
Jim, thanks. It's really interesting to hear the perspectives from other segments of the market. As I mentioned in our intro, we focus on fixed income, and to some extent, fixed income has lagged behind other asset classes in its journey towards electronification, automation. We look at it in the following way. If you're looking at automation or automated trading versus electronic trading can include, you know, it's really workflows that can include the trader's intervention, I think what Ashley was referring to earlier. Whereas fully automated trading is basically leveraging the machines to, you know, to do the full set of trading workflow for you. So it's really how do machines support the traders in their decision making and their trading workflow to get it done efficiently, accurately, you know, faster, or how can machines do the full job and basically get the traders to focus on strategy and make, you know, bigger picture trading decisions to drive the machines. That's how we look at it. So it's support. Really, we're on the path of trying to support the traders to make better decisions and give them the ability to be hands-off when they want to be.
Got it. That makes sense. Now, Enrico, you are one of these traders. You're a kind of user of this type of technology. How do you see this? How do you see trading automation?
Right. I think we have to think about what is, and as Ashley mentioned, what is automation? I think our ecosystem is designed really, it's still legacy human intervention, whereas the future is really changing the ecosystem to a more designed for machine readable. And what I mean by that, just a few, you know, key words is like bridges, interconnectivity, distributed and shareable and binary information. And that's where a lot of the work with CalcGuard technology as a chair on that has been really helping build that ecosystem, will allow in Voya Investment Management to really create a much, you know, straight through process of essentially, let's look at inputs and what are our actions and analyze and feedback that information. You know, our entire, you know, look at our algos, right? Our algos is qualitative information, you know, medium, high, low urgencies. A machine can't read that. And leveraging, you know, NLP, machine learning, and create an interconnected ecosystem that allows from end-to-end consumption and evaluation.
That's really helpful. So actually, I think one thing you all have in common there is saying that it's as much about making the role of the human more valuable, perhaps even more interesting, and saving labor and all these other things, albeit with slightly different nuances. I think all three of you perhaps have slightly different sort of approaches to that, which is quite interesting. On which let's go to the audience. We have a poll question for you, so we have a bit of audience participation. Let's get that. Thank you very much. So please poke the answer of your choice. Do you feel that we have made the right amount of progress in automating trading? So yes, we have. No, we are a bit behind. We could have done a bit more, or we've actually done more than we expected to have done. Okay, what have we got? All right. Okay. I mean, not entirely unexpected on the last point. That is probably to be expected. No, we could have done more. That, I guess, the panel, do you feel that's a surprising result, that we are, firstly, that kind of a third response thing, we're actually done a pretty good job, and secondly, that we're quite well behind. Does that feel right to you?
We can always do more, right? Automation's just getting started.
Yeah. Okay. So let's talk about that a little bit more, in a bit more detail. So, we've achieved a lot, it's safe to say, over the last, couple, 2 or 3 decades. So we've really been doing this. What really has been achieved so far? Would you say it's been a success? Have there been any failures? And are there any surprises? Things we just didn't expect to happen along the way. George, do you want to kick us off on your thoughts on that?
Yeah, that poll was a little surprising for me. Like I think that we either made the right amount, but I also think that we've had quite a lot of success in automating, especially when it comes to the buy side. I mean, I see a lot of shift, and a lot of the tools are getting cheaper and cheaper and more accessible and more understood by the buy side. And it's because of automation has allowed them to really figure things out quicker. Get the tools that they need, especially around risk management. But I've seen a lot of focus. I've seen very small teams, 2 PhDs in a room to be able to really affect quite a lot of trading that would require like 20 or 30 people 10 years ago. And I see that pretty routinely. And it's because of the really good risk systems that they're using. And I've just seen tremendous quality getting there. I'm also seeing a lot of people that were always at bigger shops or at these kind of specialty trading firms where they had capital and they had technology. That's what really kept them there. They can now move on their own because of cloud-based technologies, cheap GPUs, things like that. They can kind of stand up kit much cheaper than they could have done in the past. And, that's really served a lot of people well to be able to cut their own path and really get creative and making a lot of changes. I mean, your other question about what was the last part? It was like something about
surprises.
Yeah, the surprises. The surprising thing for me that I kind of went through on the equity side of things was the whole the issue, right after the pandemic and with, the Reddit kind of AMC and, all these things. Like what really came out to light was how the regulators are working very closely with, for stock loan, and how unautomated some of these things are. So my clients were very surprised by this. It really caught a lot of them off guard. A lot of them lost a lot of money because they did not expect to be kind of stuck like that, where their models now had to be turned off. And they were in a position where, they were taking way more risks than they thought they were taking. And they felt it was just kind of an arbitrary thing. Now, those kinds of things did smooth out. It did take weeks, maybe months. But, that kind of really brought light to new things. But what I saw was that quickly, especially these smaller shops, they quickly adopted to that. They coded things up so that wouldn't happen again. And that was very remarkable to see the speed of that take effect.
That's an interesting point. I guess the trading world has always thrown up surprises, but the ability for, even in a very automated environment, to be able to react that quickly and solve for them is a very encouraging sign. That's very good to see. Enrico, what's your perspective on the investment management trading side of things? How do you think we've done?
I think we're progressing. I think like in the polling question, I think in the middle, we're doing a great job, but there's definitely improvements. And I would say COVID and the pandemic kind of accelerated our path to automation in a sense that if you look, just NASDAQ came out with their partnership with AWS, and then you have another partnership, I believe it's CME with Google Cloud. Essentially, really, one is cloud computation and two, cloud storage. And I think the growth and sort of slow acceptance of cryptocurrencies, not really cryptocurrencies, because that's more sort of the utility of that, but a blockchain methodology to allow for ways to permission and to validate, using hash of transactions, right? So you're going to start to see a lot more of that, I think, in financial services, that adoption. And I think that's where we go, because traditionally, and I think still to this case, you see a ton of silos. What I mean by silos, like think of because Voya is a sort of a quantamental, or the trading desk, we do, active, fundamental, quant, and more and more towards systematic trading, is the relationship with a portfolio manager trying to make decisions, and maybe they're an active fundamental manager, have a big block, and they have to sort of partition fragments of the order. Whereas I think in the future, you're going to have a PM be able to put, okay, I want to buy 2 million shares, and then a system to immediately react to when there's an opportunity in the marketplace to make that transaction much more of a systematic process, an automated process, versus trying to go to the trading desk. That trading desk tries to hit high touch desks, and then that high touch desk goes out to other buy sides. It's very inefficient. I think that's the direction we're going to go. Is it's going to create interconnectivity in a much more systematic, interconnected marketplace.
That's interesting. So it's a lot more than just about machines. It's actually about the whole sort of social infrastructure, if you like, of trading, and all the firms involved. And thank you for introducing me, certainly, to the word quantamental. I hadn't heard that one before, so that's a good one. We go to the word FIXinar. You've given us continental. Mark, what are your thoughts on this?
Well, thank you, Jim. It's been very interesting hearing the comments from George and Enrico, and that I'm picking up on something George said earlier. We talked about this democratization of technology. It used to be, if you're a bank and you could afford this, this compute power, you could afford to, invest in technology that was going to give you an edge. I think that democratization has shown that, two people in a shop can do the things that George was speaking about. And Enrico's point about silos, we find that very much in the fixed income space. Fixed income is still very, very fragmented marketplace, and a lot of data is very important. Data is held in different systems and different silos. This interoperability that Enrico was just touching on, we're seeing that more and more. And it's these two key trends: this democratization of compute power and availability of interoperable systems. FIX is playing a very big part in that too. Obviously, it is helping to evolve this ecosystem and to improve automated trading and electronic trading, and we're certainly seeing that in fixed income. It's COVID, I think somebody mentioned as well, has really propelled that forward too. So it's been interesting to hear those themes coming through from the other market segments.
Brilliant, thanks, Mark. And it looks like FIX has got a long road ahead, if you like, in terms of continued involvement in that process. So I'm very happy to that the organisation is helping out with that. Dennis, we haven't heard from you for a little while. What are your thoughts on this, both on terms of the achievements and the failures, and why?
Thanks, Jim. So yeah, very good points from Enrico and Mark and George as well about that. So just wanted to kind of mention again that point about the democratization of technology, as Mark put it. So the systems, the trading systems in general have become more kind of lean and standardized, and so they were easier and cheaper to build, because the commoditization of hardware, of course, and very well understood techniques around things like failover and recovery and resilience in general mean that it becomes exceedingly easy to kind of build new systems and deploy them. Sometimes just even on a single box. For instance, with Cantor Algos, we trade in equity space and fixed income and FX as well. And most of our systems can be just stacked up on the single, essentially a single piece of hardware, completely commoditized and easy to deploy. That also means so the proliferation of these standardized components and standardized techniques also means that the prototyping has become faster. So it's easy to build new things, try them out, and discard if necessary. And the corollary from that is that it becomes easy to customize things as well, right? So to build something bespoke, it's a much easier and cheaper endeavor. If you want to, you can pretty much build an entirely new bespoke ecosystem if necessary and deploy it. Try a couple of things and discard and build something new. So I think that's a tremendous achievement. Just the whole development process has become much more. The lift is easy and kind of fun. So that's a big one, and I think it's going to be driven even further towards cloud and so on. But there's certain gaps, of course. For example, I think I feel that middle office and back office are still kind of behind a little bit, and they're definitely ripe for some innovation in that space. And to Enrico's point, and I think specifically these areas can benefit a lot from using distributed ledger technology or blockchain as one version of that. And of course, I mean, some asset classes are a little bit ahead than others in terms of technology adoption. Equities are traditionally a little bit ahead, and we feel it ourselves quite acutely. So that's so there's a lot to do, and but I think there's still a lot of progress to be made on that front as well.
That's brilliant. Thank you very much indeed. Before we carry on, let's just quickly turn it back over to the audience. We have another question for you, if that's okay. So, Amy, if you wouldn't mind, here we go. So, again, poke the answer of your choice. What do you see as the main benefit of or reason for pursuing automation of the trading process? Do you feel it is most important to reduce costs, to reduce risk, or to innovate more quickly? Okay, let's have a look, shall we? Interesting. Okay, it's not that far off an even split. A little bit ahead on the risk side, a little bit ahead on the innovation. Okay, that's an interesting result. That's not one I would say I would necessarily have expected, but very good to see. Let's talk about that then. Okay, so benefits and perhaps also the risks of automation. And I think guys, you've talked about many of the things that are possible now that weren't possible a few years ago. It's particularly the speed of innovation with the modern technology gives, and that sounds like that possibly is a double-edged sword. Let's start off, Dennis. What do you think about this? Where do you think we can go well and go wrong?
Yeah, it's interesting. It was interesting to watch the answers. So actually, on the risky side, yes, innovation is fun, and fun is typically risky, right? So no matter what we do, so that's definitely like a very sharp topic, I think, especially with the increased availability of technologies, particularly for retail investors and retail traders. I mean, if you look at some of the modern APIs to connect to the trading venues, and it's actually easy to get market access these days. Well, much easier than it used to be, especially if you look at some of the new asset classes such as cryptos. It's like remarkably easy to just even build simple bots to go ahead and trade, and it's a little scary at times. And I think some of the unknowns and risks will come from that direction, especially given the fact that in some markets, people can trade on gigantic leverage, like ridiculous margins. So I think some of the risks will come from there, because something will at some point will break, and we don't even know what it is. So it'll be fun to watch and fun to fix, I hope. But in general, I think automation, of course, brings a lot of advantages, and there are obvious ones, such as things can be done faster and probably safer, but also I guess electronic automation brings a dimension of commonality and objectivity to the process, right? So I guess less room for human error or human as we remove the human factor or reduce the human factor. So a couple of things become easier. So the whole execution quality criteria, they're clearer, first of all, right? They can be analyzed, they can be discussed, they can be reasoned about. So I think there's a lot of, like I said, there's a lot of commonality and objectivity to the process. So that's the main thing about that, at least to me.
No, that's good. Actually, would you agree with that? How do you see things?
I definitely agree with Dennis's opinion. I mean, automation is a novelty, and with that newness brings some risk. But if you look at the equity space, we've been automating for 6 or 7 years now, right? With the advent of the algo wheel, and inherently over the last 5 or 6 years, we've reduced the number of variables in the decision process, right? We've made people's lives easier. We've made TCA easier. We've normalized the broker algo tickets. We've reduced the number of parameters in the UI. You get that true apples to apples measurement. But as we continue to expand, let's say we integrate machine learning into the algo wheel and the automation process, and that machine learning comes in and starts to revise your orders, right? You're changing your appetite for risk, you're changing your time duration, you're changing your urgency. At that point, that intelligence switching kind of muddles the measurement there, right? And you kind of lose that apples to apples approach. So yes, there will inherently be more risk as we continue to evolve, but I don't think it's going to stop us.
Okay. One thing which I just want to throw out is from a regulatory perspective. I mean, it's best to all of you. I mean, it sounds like there's a lot of change already underway, a lot of change coming. We know that regulation is relatively slow to keep up. Is there anything that we could be doing differently or should be doing differently, or the regulators could be doing differently to kind of keep on top of this?
That for me.
Anyway, yeah, actually, if you would mind, yeah.
From a regulatory perspective, I feel like through automation, we have more information and more logging, right? Think of the advent of CAT, right? We have a prescribed set of rules and parameters that we now need to report. So if anything, I think that automation, at least from a vendor perspective, allows us to say, here's all the information we have at it, right? And it's up to the regulators to kind of sort through that noise and tell us what they want.
Okay, so data good. Yeah, I think we can probably all agree with that. Thank you very much for that. George, what are your thoughts on this?
So, one thing that's happened because of the pandemic, but it clearly was happening before that, was, this whole money printer go brrr. They are printing money. Quantitative easing is just forcing everyone to take more risk. I don't know if anybody's seen the announcement, but last month, CalPERS and Ontario Teachers Pension, they all said that, hey, we're going to leverage our portfolios, which has not been done before. And it's completely amazing because everybody is looking for yield. And so if you've got equities, all the assets, fixed income, all the assets across the board are really high right now. And in order to be able to get the yield, so these pensioners can actually retire one day, they're taking increased leverage. Well, with the increased leverage comes a lot more regulatory scrutiny, but just scrutiny all around. And this is completely a function. The only way that these guys could do something like that, because it's just remarkable that they would even announce something like this, is because they've invested a lot of money into real-time risk systems. Clearing firms and primes have invested into real-time risk systems. Those systems are getting better and better. The days where, you know, they would do 10-minute snaps of where positions are disappearing. I've worked with some clearing firms that had like very highly automated, sophisticated, real-time volatility based. They could cancel a portfolio or position automatically. It's you know, and the technology is getting cheaper and cheaper to do something like that. That can only happen with, you know, automation and standards to be able to achieve that in a very predictable, safe way with, you know, much lower investment than you ever needed before. So that's the kind of thing that I'm seeing. A lot of efficiencies, a lot of money being poured into the real-time risk part of things. And but it's all a consequence of, you know, this leverage that's happening right before our eyes.
That's great. So there's definitely a recognition that the risk is out there and people are actually actively doing something about it, which is great. Mark, what about your perspective? Again, as a supplier of capabilities and technology, how do you see kind of risk management fitting into all of this?
Yeah, thanks, Jim. It's been really interesting hearing the perspectives. I mean, obviously, from our point of view, risk management has to be built right into the trading workflow, you know, right at point of trade or even before. You have to know what you're getting into, how you can manage the risks and control them afterwards. So that often means from a technology point of view, we need to integrate with risk systems because very often the risk is centralized in a different system. And that speaks to the interoperability we were talking about earlier. But there was another point made about the regulators, and there's a really interesting discussion going on both sides of the Atlantic right now about how to achieve transparency in the fixed income markets. The data that Ashley was talking about, in fixed income, there's no sort of centralized source of, you know, what is the price for a security. But, you know, even to achieve a common understanding of what that is involving such a lot of debate, and it's revealed a lack of understanding, a lack of real sort of depth of knowledge in the regulators. Mr. Gensler in the States is going to try and push all bonds onto some sort of centralized exchange like they did for interest rate swaps, moving them onto swap execution facilities. That's his stated goal, to try and enhance this transparency. On this side of the Atlantic, the ESMA, the European Securities Markets Authority, is pushing for a consolidated tape. But then on the other side of the discussion, on both sides, people are saying, well, if it's a very big trade, we need to defer the reporting by 2 weeks because we don't want to create some sort of over-transparency and disadvantage ourselves or get cornered with a very difficult position in the market. So, you know, you have this debate which really is lagging behind the reality of what's going on in the markets. And so the regulators are always kind of trying to catch up. And the other thing that we're seeing is that technology is constantly moving forward and people are prepared to take risks. But in a regulated business, in a financial services industry, you really need to test everything as much as you can before you push out new technologies. Inevitably, though, to Dennis's point, something's going to break. And it's not always that much fun fixing it afterwards. Sometimes it's a hellish scenario, but it has to be, you have to test everything as much as you can. And therefore, automated testing is becoming much more the norm in our industry as well.
Yeah, that's good. And I guess the technology to achieve that in a safe and scalable manner is obviously improving all the time as well, which must be a big benefit to achieving that. Enrico, over to you, if I may. Where do you think we've got to in the automation chain, and how much further do you think we've got to go?
I think we just got started, and I see we have a question too talking about FIXAPI, which fantastic question, because I think that's a critical point of what I want to talk about. As we spoke about risk, I think automation is a risk reducer, and we talk about transparency. We're typically, again, we're doing qualitative interactions. We're not capturing intentions and actions throughout the whole process of an investment, right? No matter what asset class it is. Whether it's an analyst makes a determination on a stock, or it's an optimization process within quant making, you know, a multi-factor decision, capturing that information, capturing the factors, disseminating that downstream, disseminating that into a very qualitative urgency into an algo, right? Look at our algos. Our algos are designed for humans, you know, urgencies, right? Dark, liquidity seeking, you know, IS, those are we need to consolidate that into one and make it much more of a binary qualitative interaction. And then talk about fix the API. I mean, I think it's crazy to think about that we have to wait T+1 to see what's going on downstream in our transaction cost model. That has to move into a real-time, in-stream evaluation of what's going on downstream as orders are taking place. Because what that'll allow too is for upstream to start to evaluate using AI or machine learning techniques to evaluate transactional occurrences occurring in the market and allow for re-optimization based on, hey, I expect it to be done 20% of this order, but I'm 10%. Okay, let's adjust my urgency or whatever it might be. And then from a regulatory standpoint too, is if you're capturing all these data points, let's look, part of CalCard Technologies is incorporated within the fixed layer, an intention code or routing transparency initiative. Why did I route to this venue? So I can see, is there economic incentives because I went to this venue versus another venue, right? Whereas I'm capturing what was my intention, what was my action, right? So not only does it provide transparency from a regulatory perspective, but it also provides, I can see, was that action valid? And I'm not trying to validate, if that was the right move or not, but it allows transparency. And from the real-time perspective, when we talk in the question about fix API, the CalCard Technology, what we're trying to do as a consortium is to take raw fix messages, whether it's fixed drop copy or an API straight into, say like Virtu's KDB database, right? And taking all that information and ingesting it, right? And making it field level encrypted and permissioned in a cloud environment, and it does anywhere. So, and now I'll be able to create an API and then share that information with my risk team, my PMs, whoever it might be in real time. And I'm not waiting till the next day to do it. And then I can also permission, maybe I want to share my TCA information with another buy side to help create a larger data set to say, okay, these brokers in this algo wheel are best under these conditions. Well, without that, it becomes much more of a struggle. And so I think in that case where we're leveraging automation to capture more data from end to end, it allows for automation and risk reduction.
That's really good. Thank you. So I think the key points that keep coming up here, data is something that keeps coming up, and I think Mark earlier made the point about that we have data in different silos for different asset classes and different jurisdictions, different formats, of course, and the role of standards in trying to straighten some of that out. Obviously, a big sort of theme ahead of us, on which a lot of words have come up in the conversations we've had so far on this panel, and a lot of kind of cool things that are out there in terms of emerging technologies and emerging changes. So, George, I think you threw in GPUs. We've got cloud out there. Machine learning's come up a few times. What do we think are the big thematic changes that are out there that could impact the automation of trading, and in what way? George, you've obviously given us quite a few of these words, so let me turn that over to you to start off with.
Yeah, Nvidia GPUs on the cloud, that was a pretty big change, and also there were changes made in the GNU compiler, C++ compiler, to be able to take advantage of the right calls for that, and that really happened about two and a half years ago. And that was a tremendous change. And that's why you saw just an explosion with, NVIDIA, people using NVIDIA, and then putting it on the cloud just made it really, really cheap and accessible for people to play around and really get used to it. And that's been amazing, seeing the results from that, volatility calculations that extend to make very simple risk systems and things like that. Obviously we know that AI is coming. AI is just getting drastically cheaper every year, all the tools. Not just the stuff from Google and TensorFlow, but like everything is just getting cheaper and cheaper regarding AI, much easier. It's getting put into things like Python and everything else. The one thing that I saw during this the last retail run up which was really surprising and really interesting, is that our generation, let's say millennial, Gen X, that kind of generation, when you made a bad trade, you would hide it, right? These guys, the Gen Zs, they are socializing these things. And it's amazing to see like all the stuff that you saw on Reddit. I mean, if any of you have seen some of that, it's just remarkable how they're making fun of themselves. I see it on the options boards all the time too, which never happened, even a few years ago when people were using it. Now I know I'm saying the retail, but I know it's moving into institutional, because many of these people are going to take their success and move it at the big, large institutions in the world. So we're going to see how that's going to be used and how it's going to contribute to people constantly learning, figuring things out, getting more automated, socializing all of their failures, socializing all their successes. I don't know if the industry is ready for that. I know the regulators probably aren't, but I know that the industry is definitely going to be much better when we have this like global, huge learning that's going to happen because of this.
That's interesting, because that speaks to not just the change in technology, but basically a generational approach shift happening as well, which is probably just as big. Dennis, what else have we got on this topic? You've got technology changes. I think you sort of mentioned some kind of market structure type implications in your comments to earlier questions. So where do you see this all going?
Yeah, for sure. So, well, just like I mentioned before, so because infrastructure becomes more and more kind of commoditized and decentralized, I think we're gonna see the increased movement to the cloud. So it's been proven recently. I mean, there are even some papers about that you can build a fully functional trading system literally on a commoditized cloud machine, because before, there were a lot of arguments that it would be too slow or unreliable. Well, it turns out that no, it's actually quite possible, and ultra low latency is not a factor at all in 95% of cases, maybe even 99% of cases. So that will happen. That will also hopefully, to Enrico's point, this kind of consolidation of data and making data stored and in one place, hopefully will allow for some serious data mining for everybody's benefit, because it doesn't have to. It can be done in a secure and sort of anonymous way. But if we get all that trading data in one place and just apply some data mining and advanced analytics techniques, maybe something will come out of that, some new interesting patterns that would benefit the industry and the investor community as well, in a generic kind of way. Also, I think I guess the whole notion of trading will become more and more available to retail investors and retail traders. So going back to George's point, it's actually quite true. So it's like if you read some of these Reddit threads, they're boasting about their mistakes, right? So somebody said, you know what, I lost $500,000, and somebody responds, you're an amateur, I lost $1 million. So and then so just that's definitely going to be a factor, especially with proliferation of commonly available APIs. It'll so maybe at some point very soon, probably it'll happen, the retail traders will be able to create their own actually trading strategies. So there will be platforms that will allow them to do that. There were some early works years ago on that front. Of course they didn't take off simply because of the regulatory framework and technological limitations, but now I think it's going to be possible. So another, I think, interesting area of development, and this is very emerging but very promising, I think, is basically kind of peer-to-peer, you can call it a peer-to-peer liquidity discovery or decentralized exchanges. I think that that innovation came from digital assets, but I think that's a very good idea and very new, and I think these will gain traction, not just in the digital asset space, but will probably move into other asset classes. It's the idea is that and this will have direct implications in the market microstructure as well, and the research that's going on in that area. So the idea here is that you don't have a kind of a limit order, centralized limit order book, but instead you have this peer-to-peer interactions, and the price is set in some deterministic way that can be analyzed mathematically. So I think that's a very exciting area of development, and these will grow in popularity. And of course, you know, hopefully we'll see more innovation in the middle and back office space. They can probably seriously benefit from the distributed ledger technology, or like blockchain, for example.
That's interesting. I mean, there's a lot of different themes there, from the technology almost in existing processes to completely new processes. If you think about trading as a process and the market structure around trading, being the infrastructure in which you undertake that process. Mark, perhaps we just pull it back to the technology side of things. And obviously, as a supplier of technical solutions, you presumably are being kept awake at night with what's going out there in the world of technology. What do you see coming at you?
Well, just touching on what Dennis was saying, it's really interesting about your point about cloud technology for trading systems. Our clients have adopted that a couple of years ago now, and most of our customers now run their trading systems in the cloud, and it's been so fast, and it's offered them access to compute power that they never would have had before. So the rapid rise in compute power and data storage and retrieval has been a major factor. The other thing I think we talked about, didn't really get into a lot of detail, is the fact that these systems are also themselves producing data. So it's the ability to leverage and use much more data in the trading process, which helps to maybe better inform or give a different perspective, that these systems can absorb all of this data in real time and use it in the trading process. But they're also producing data as well. Ashley was referring to TCA type data that can maybe be used further in later trades. I don't know, but the idea that these systems are just consuming data is also that they're also producing data as well, and that data then can be used elsewhere within the organization. So it's this increase in compute power, which is definitely, we see that trend continuing, and the move to cloud clearly. Democratization of technology, meaning that new entrants can gain more access to this technology quickly. So George was talking earlier about new types of players coming into the market and building systems and building models. I think that's going to have an increasing effect, and I think what that'll start to bring, it'll bring new or maybe even traditional other participants into the market. I said on a conversation we were having before this call that I wouldn't be surprised if someone like a Google or obviously an Amazon starts to look at all the data that's coming through their systems and look at how they can figure out how to distribute, monetize, share that data, and that's going to further drive this broadening of this broadening of the process. So it's a process that's kind of, how can I put it, feeding off itself in some respects, at least in regards of the data that's being used and generated. And one outlier comment I'll chuck out there. I had a very interesting comment a couple of weeks ago with a quantitative trader who's saying that he's looking forward to the advent of quantum computing. I had to really look into what that meant, because it's still a very new front, but I think there are new things, new innovations that are going to impact our market in the next 5 to 10 years that we haven't really probably appreciated yet. And that might be one of them, but I don't think we need to keep ourselves up at night worrying about that just yet.
That's very interesting. Yeah, quantum computing, we talk about it a lot, and it's always kind of a few years away, isn't it? It's a bit like nuclear fusion. It's one of those. Enrico, we talked about a lot of factors kind of coming at the industry or being originated by the industry. Obviously, I guess you're kind of on the sharp end of this in terms of actually really kind of making use of all of this. How do you see this evolving?
I think we're there. Except for, I think the biggest inhibitor, we kind of brought this up, is a regulation, right? I think regulators are, inhibit innovation in a way, not negatively, but more protection of the consumer. And if we look at the demonstration of with cryptocurrencies, blockchain, digital ledger technology that was unfeathered by regulators, because they kind of didn't look at it and look at the growth and what's transpired, the innovation that came about, and now now regulators are trying to come in and try to control that, and just, justly, but that just is a demonstration of how the innovation can take place. And so I think for us to really get to the next point, we not only from a regulatory like an SEC, but more for internally compliance, risk, even like a CISO, is getting them comfortable from, look at how our data, especially transactional data, is FTP'd, secure, transport over, over lines, right? And how, besides perimeter security, really, if someone wants to get a hold of that data file, it's not encrypted. And I think getting CISOs compliance comfortable with if something is encrypted, field level, and then permissioned, you have much more control, more protection, right? And it becomes an added protection and controls that allow for trustless transmission of information. So no longer secure lines, it can be trustless, because if someone does break into a cloud environment, they might get one field, that's it, right? So it becomes much more secure. But the challenge is as anything is new, is people tend to be fearful of new things because they might quite not understand it. So it's really education and adoption. And I think that is really gonna, once we get to that, it's really gonna create a lot more advancement in the automation space and sharing of data that we can use to make better decisions collectively.
That's really helpful. So provision of data, trying to make the whole area more transparent. Dialogue early on in the process sounds like it's key as well, with regulators and anybody who cares about them, sort of managing what's going on here. Look, there's a huge amount of change coming up from what you folks have basically described. It's coming up from all sorts of different directions for all sorts of different reasons. So it sounds like basically if you don't like change, you're probably in the wrong industry. Something we've probably said before, about so many decades ago. Let's throw it back open to the audience for a second. We've got another poll question, and it really is related to that topic of change and kind of things coming in the future. So imagine that you have a 3-year-old child, and they say they want to be a trader when they grow up, and that could be in 20 years' time, let's say. So what do? Do you send them on a preschool economics course? Do you send them on a preschool Python course or computer language of your choice, or do you simply put them up for adoption because they're completely crazy? Please give that a modicum of thought, and let's get some responses going. Right, what have we got? Okay, send them off. Okay, interesting. Well, good to see about the third option. That's good to see. That's a nice small number. Okay, technology clearly is the way to go, and that probably isn't too surprising here. Obviously, a decent number of people talking about still perhaps this sort of traditional approach as well. Let's quickly, just we had a Q&A question just come in actually about on a similar topic actually about what traders might be doing in the future. Let's ask the question: what would a trading desk look like in a couple of decades' time? We're right up to time. So actually, can you just give a few seconds on what you think the role of the trader is, what desks might look like, and so on?
Sure. I mean, for better or for worse, the one thing we know about automation is it takes the value out of human interaction, right? And if we look at the past 2 years and the pandemic and the shift to work from home where everyone's isolated, you're operating from your guest bedroom or your basement, that communication breakdown is already there. We're already separated, right? So automation has stepped in to solve a lot of those problems. And I can say over the last 2 years, we've seen a significant expansion in the use of automation amongst our clients. I mean, it's really blown up. The average client uses 2 or more algo wheels, right? So everyone's in it. I feel like a lot of clients who were not involved in automation before the pandemic, who were isolated and maybe didn't have their technology or IT teams around to help facilitate that change, I feel like they might have fallen behind a little bit. And now with return to office, or, you know, people getting more comfortable in this new way of life, automation is really taking hold.
That's really interesting. It's interesting you mentioned the pandemic as well, because clearly that's an example of a theme that kind of threw everybody off a kilter a little bit, and has definitely made some changes. I mean, Enrico, I mean, you're obviously on the trading seat yourself. What are you going to be doing in 20 years' time?
Well, 20 years, that's pretty far off for myself. But, you know, I think you know, if you follow Moore's law and, you know, as far as computation and, you know, apply it to what's going on within financial services, and the point I said about regulation, and comfortable with that, I think the financial services in 20 years is going to be totally different. You know, as mentioned earlier, settlement, custody, stock loan, you know, I think digital ledger technology is going to automate that and validate that. And, you know, whether you're trying to look for a stock loan and it becomes more of a blockchain, a smart contract, settlement, the same thing. And I say tokenization of assets is going to change things. I think how trading occurs in exchanges and distributed sort of trading like DeFi and cryptocurrencies is really going to change totally different. And I think it's going to be much more of a distributed sort of tokenized environment that we're going to see in the future. Global, multi-asset, very interconnected. But we just have to provide that ecosystem again to allow for that growth and innovation.
That's great. Thank you very much indeed. We're pretty much at time, so I'll skip the rest of you if that's if you don't mind on this particular one, because we need to wrap. I just want to say firstly, thank you so much to all 5 of you for your comments on this. You know, it's been absolutely fascinating what you've had to say. You covered a huge amount of territory, and it's quite clear that you know, there are a lot of things kind of coming at the industry. There are a lot of things that the industry is creating in its own right. And there is going to be a huge amount of change over the next any number of years you like. You can name a time frame of your choice. It's going to be all systems go. Amy, if you would mind sort of flashing up the kind of closing messages, if you like. I think it's safe to say that obviously from a FIX perspective, this is of course a FIX event. You know, there are a number of initiatives and working groups underway or planned that really speak to some of the things we've talked about here. From digital assets, of course, we talked about crypto here, some of the data groups we have. We've got a lot of business transaction flow groups on here as well. And this is really just scratching the surface. Probably worth just calling out Orchestra. I think a couple of questions were raised on the chat as we were talking about you know, how FIX can be, you know, almost automated in terms of the usage of it, and Orchestra is the solution to that. So if you want to know any more about that, you know, and its implications for automated testing, machine readable FIX rules of engagement and so on, then please talk to the program office towards the end. So if you want to join any of these groups, please talk to the program office. You know, details on the slide. We also have a number of events coming up. We've got the EMEA Trading Conference in a few months' time in London. We are looking to host the New York event in April next year. We've got the Asia Pacific Summit coming up in May as well, and Nordic Trading Briefing in the spring as well. And there, of course, there is a series of these webinars being planned as well. It's all up for grabs at the moment. We're working out the schedule, so please keep an eye on that link on the screen now, the FIX events URL. That is where you'll see everything. So we're at time. Thank you so much for attending. You can watch it on YouTube, that's where it is. And again, thank you to our panel, thank you to the events team for putting this all together, and that's it. Thank you and goodbye.